Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by CARDO AI, the operating system for asset-based finance and private credit. This market still runs on spreadsheets and siloed solutions. CARDO AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $200 billion run on CARDO AI. The world's most sophisticated investors and lenders are using CARDO AI, equipping their teams with a level of control and intelligence that legacy tools just simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to our latest installment of the Credit Clubhouse podcast. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today is Ali Meli, founder, chief investment officer, and managing partner at Monachil Capital Partners. Ali, thank you very much for the time. Pleasure to meet you, at least virtually. Looking forward to our conversation.
Same here. Thank you very much for having me.
So, a lot of the conversations we have on this show are certainly private credit centric, and so maybe just start at a fairly high level. Where do you think we are in today's private credit cycle?
We think that we are at the late stages of credit cycle, especially on sectors that have attracted a lot of capital. We are seeing a confluence of a few factors converging. There has been a lot of capital committed to private credit by insurance companies. At the same time, private credit is facing a lot of competition from the banks because banks now have a lot more appetite to extend credit. And we can see that in spread environment, both public and private markets, where credit spreads are at historical heights, and you are seeing some signs of exuberance in the credit markets.
When we think about some of the different pieces of the private credit market, obviously private credit has gone well beyond just direct lending as of today. Where are some of the best risk adjusted opportunities in today's market?
So to me, it has really shifted from a few years ago. A few years ago, especially when you had the 2022 mini banking crisis and mini rate hike and mortgage extension, where insurance companies and banks had lost appetite for credit extension. It was in places that traditionally would go to those two types of sources of capital. Right now, it has flipped in the sense that the best value, in our view, is places that are not getting competed at between banks and insurance companies. Things outside of your traditional sponsor-based, broadly syndicated space have very good risk-return profile. And I think that's a theme that will continue over the next few quarters. The more insurance capital keeps coming to this space, I think the more spreads are going to be tightening. And at the same time, credit quality is getting worse and worse. But the value continues to reside in parts of the market that are not impacted by that. For example, transactions that don't get a traditional like risk-adjusted NIAC rating. I think we are seeing a lot of value in those types of transactions.
So when we think about, the kind of where the private credit market has gone the last few years, obviously a lot of the bigger names, have gotten a lot of capital, and have certainly have scale has seemingly become an advantage in the space. I'm curious, can smaller or even more specialized managers still outperform?
It's an interesting question. I think both of those types of players, if we maybe take a very simplified approach of we have these big players and then we have these smaller players. Uh, Both of them have their own unique advantages, and it's not a zero-sum game. The big players can play very well where a large amount of capital is required. Uh, for example, if you're building a $20 billion data center, big manager or a syndicate of big managers can handle that. That's where they have the competitive advantage. Also, bigger managers sometimes benefit from having an ecosystem. If you are an investment bank that sees a lot of their larger clients coming to the credit markets, you get essentially a very beneficial ecosystem of credit opportunities that coexist alongside a large manager. At the same time, smaller managers, more boutique managers, can work on situations where there is more of a specialized underwriting is required, or they can target deals that are higher yielding and lower risk because those types of transactions are less appealing for the large managers. I mean, at the end of the day, we live in a efficient market. There is always a room, essentially, there's always essentially an equilibrium that exists. And right now there are a lot of people that can do the $100 to $1 billion checks. As check sizes become smaller or become bigger than that, the number of players suddenly shrink. And it is not really a skill versus a specialization. It's more about the right type of capital with the right type of situation. There are some situations that are better fit for smaller managers, and there are some types of situations that are better fit for larger managers.
Before we dive a little bit deeper into direct lending and some of the other markets, tell us a little bit more about your firm. Where do you guys kind of focus on in the market? Maybe just give us a little bit of overview of Monachil.
Sure. So we are a lender to other lenders, and we are an underwriter of other underwriters. We focus more on niche specialty finance platforms. Think of it as consumer lenders, auto finance originators, business credit platforms, revenue-based lending, and fintech lenders. And are really focused on providing people with their first institutional credit facilities that allows them to scale from less than $10 million to numbers that are north of $50 million. So we view ourselves as providing senior secured financing to the types of specialty finance lenders that right now, for one reason or the other, don't have access to your traditional insurance linked or your broader private credit markets. They might be too small, the situation might be too complex. They may not be syndicate ready. We don't typically do syndications. What we do is structure our own deals, work with these specialty finance companies to figure out what is the right structure for them and provide them with the right type of capital that matches their needs.
Because direct lending has been in the news for some negative reasons as of The last few months, you can probably even go back into to the last year. Given, where you guys sit, have you kind of seen a shift from those that are indirect lending, maybe going to specialty finance in some of the areas that you guys focus on? Is that area of the market, your area of the market, becoming increasingly crowded, given maybe people trying to diversify away from that traditional direct lending?
Very good question. We are definitely seeing more entrance in the what I call investment grade part of asset-backed finance. The larger players are coming there, but also at the same time there is more and more assets that can be financed there. Like think of consumer loans, especially like prime consumer loans, near prime consumer loans. There is a lot of supply and there is a lot of demand. It hasn't necessarily gone as competitive as, let's say, middle market, broadly syndicated loans or middle market lending, sponsor finance types of transactions have become. And then if you focus on our little niche, that was things that are not necessarily like insurance company friendly, and on the smaller side of things, earlier stage type of transactions that wouldn't necessarily be the right fit for one of the larger managers. If anything, we are seeing less competition over the past few months in this particular sector. And part of it is capital is leaving the space. We are even seeing that some capital is leaving the specialty finance focus vehicles, like some interval funds, some BDCs that had indirect exposure to specialty finance. They are all pulling back. And if the home for something is not an insurance company balance sheet, if it is too small to get a rating, those types of opportunities are still looking for a home.
What are some of the more interesting opportunities you're seeing in asset-based finance? That's coming across your desk. I know you guys have obviously focused on specialty finance for quite some time.
So recent months, we are seeing more activity in the MCAs, and then we are also generally like anytime you have technology reducing the cost of origination and reducing the cost of credit management and credit operations, that creates opportunity set. So we are seeing that in consumer lending, and also autos is another interesting area, because there was point in time, and I've seen these mini auto cycles play a few times over the past few years, where capital is scared of the sector, then capital becomes too attracted to the sectors, then something blows up, and then capital leaves the sector. We are seeing some resurgence in demand for capital there as well, that allows us to get better risk-adjusted return.
Is there any parts of the ABF or specialty finance market that are, that you think are undercapitalized?
Yeah, generally, like if something doesn't fit into NIAC rating for an insurance balance sheet, the pool of capital that is eligible for that is substantially less. And those are the types of assets that are looking for a home right now. And that has been, I wouldn't say a problem. It's just that things that have been eligible for insurance company balance sheet, because you can get a rating on them. Because right now, a lot of these types of transactions either go to CLOs that are owned by insurance companies, or they go to private credit managers that are sponsored by insurance companies or get their capital from insurance companies. There is a lot of capital that has come to that type of opportunities over the past 6-7 years. We have seen how some of the biggest asset managers all of them have bought insurance arms. At this point, if you're a large asset manager and you don't have an insurance arm, people are saying, well, maybe you're not grinding it hard because where is your insurance arm? Uh, and, and by the same token, things that don't have find their home in insurance company balance sheet, either directly or indirectly, are places where you can get risk-adjusted return.
If we think about the other side of the table, the specialty lender, the consumer lender, the fintech lender, curious, the non-scaled or the earlier platform, are they at a significant disadvantage today if they're not able to scale, or are they still able to maybe carve out a niche within a specific segment of consumer or SME or whatever the asset type might be? It feels like there's kind of a have and have not in the market. You have some of the larger scaled fintech lenders, but some of the smaller ones either aren't able to get to a point where they're monetizing enough of their business, and so maybe they're bought up. Is that area of the market kind of a concern for younger platforms?
It all is specific, and every situation is different. I mean, first of all, someone being bought up is not necessarily, in my mind, a bad thing. If you have
That's
a
true.
fintech lender that is being absorbed by another larger fintech lender, to us, that might be the right type of exit for them, provided that each business is making sense. Sometimes people do merge or they do acquire to hide problems, and that's always a source of concern. On the other side, the competing factor that I've seen play many times over the past 10 years is the cost of technology is dropping. What it takes to run a fintech platform is actually there is less barrier to entry. You no longer 15 years ago, you had a couple of like large branch-based consumer subprime lenders. Now, a lot of that has shifted to people who buy leads, and you are buying leads from Google Ads or from some of these essentially online advertisements,
Hmm.
and then you try to convert them to transactions. Yeah, there is still mail campaigns going on, but there is the online component is also fairly strong. So that gives more opportunity to newer entrants who may not necessarily have legacy system and legacy costs. So it's a little bit of a competition between, are some of the more established larger platforms bogged down by their systems and technology? Is there an opportunity for earlier stage platforms to be more efficient in the way they deploy technology? Um, you know, is there, and then there are more and more tech providers that are willing to provide technology solution to lenders. There are like fraud, essentially detection software providers. There is the lead gens themselves. There are many. There are credit underwriting. Used to be one or two, but now there are many providers of that credit underwriting. So I think the ecosystem is getting better and stronger, and there is more competition, and that competition among system and service providers is making life easier for some of these online lenders. And again, a specific knowledge about maybe a specific type of niche product, there is always value in that. So we have seen that working on. At the same time, not everything is going to work out because, if someone doesn't manage their expenses, or if there is not the right type of product market fit, or if the niche market that one is targeting is so niche that it never scales up, there might be a
Yeah.
problem there. So we have seen essentially both ends of the spectrum in terms of both opportunities as well as challenges for earlier stage um, lenders or fintech lenders that are coming to existence. And then there is the big opportunity that maybe deserves its own thing around how does AI impact fintech lenders?
Do you think private credit managers are thinking a bit more closely about liquidity management and differently about it today, especially given some of the stuff that we've seen in the market with redemptions and interval funds that you've referenced a little bit before?
Absolutely. We do think that private credit managers are becoming more deliberate. We've lived in a world maybe even a few months ago where the thought process was, well, if I get redemptions, I sell stuff. And now maybe people are questioning, well, can I sell stuff? Or if my liquidity management process is based on my ability to sell stuff, then all of my investors are going to have the incentive to redeem earlier. That coordination problem is an interesting one because people may not even have a problem with the credit quality. But if you're an investor in one of these vehicles where you have asset liability mismatch and you have 6 year, 7 year, 10 year average life assets with a 2.5 year average life liability structure, the person who redeems first, even if the credit quality is intact, now there's a question about credit quality, but let's assume credit quality is intact. The person who redeems first, where the manager goes and sells the most liquid stuff, comes out a winner. So if your liquidity is based on, if essentially your redemption process is based on selling the assets and not based on cash flows, you are creating incentive for your investors to be the first one out the door. So the moment that someone hits the 5%, the moment the 5% redemption becomes the 6% redemption, 7% redemption, everyone wants out at the same time, and suddenly your 6% problem becomes a, hey, not 12% of my investor base wants to quit, because people know that the investors who stay in are going to end up with your least liquid assets. That's even assuming that the valuations are right. That's assuming that the credit quality is right. You are just creating incentive for people to want out early. And that is a problem that I think both managers as well as investors are thinking more carefully about now.
Do you expect the secondary markets for private credit assets to become, significantly larger, more liquid in the coming years?
Very interesting question. I'm not convinced that will be the case. And maybe let's break down the secondary market into two components. One of them is secondaries, in the sense that people who come and buy LP stakes in private credit or private equity, and there are a lot of secondary funds. I think that part of the market is going to have liquidity. There are lots of large secondaries funds set up. There is a second definition of that, well, if I have made a $500 million loan that's sitting on private credit balance sheet, like there is a private credit, there is a sponsored deals, they only borrowed $500 million, $1 billion. It's just a small balance sheet in the grand scheme of things. And there are 4 or 5 people or 6 people or even 10 people in the world who know what that balance should look like. You could end up, I don't think that becomes really liquid or tradable. You do need to have a larger universe of buyers and sellers who understand those companies. There are a lot of technical compliance questions around that. And we live in a world where for the past 15 years, there really has not been a compliance crisis on Wall Street. Like last time there was a compliance crisis on Wall Street was after the financial crisis, where everyone was afraid of, hey, if I sell something to someone, am I going to be exposed to the 10b5 liability? Is there disclosure? I think the board has moved away from that frame of mind, and people right now don't care. It might always take a couple of very rigorous state attorneys or a new SEC that is more rigorous on enforcement to come and question that. And specifically as it relates to secondary trading, it becomes on what information. A lot of issuers in the private credit require your lenders to sign NDAs so that you can get most recent financials. These are not public filers. These are not people who have SEC shelves. Like you can buy bonds of IBM, Meta, Google, even high yield companies, any type of borrowers that have an SEC shelf or SEC filing and know what's going on. For private credit, there is an informational challenge. The information is not with SEC. These are not registered or even 144A type of issuers. there is no private placement memorandum. There might be a data room somewhere that may or may not be updated. More likely, you can get some level of information, but can the buyer see that type of information is questionable. And a lot of the companies that have borrowed from private credit don't want their financials out. In our little sector, I know that in our niche, there are a lot of people who would not want us to share their information because like there is an expectation of secondary trading. Like we don't necessarily expect on our transactions there will be secondary trading. So when I see discussion around secondary trading, I stay skeptical because you can even see people that end up making market. You can have 2 or 3 or 4 players that end up market making on the secondaries. The challenge is if you ever have a crisis, not a big crisis, small C crisis, a few people want to get out at the same time. Will all the bids be there or not? Will the bids evaporate when you want to have that liquidity? And what will be the natural home for these type of like private credit opportunities? So the short version is I do remain skeptical of how deep those secondary markets are going to be for private credit, just given the size is small, and then there are all these market structure information barriers.
If we flip to LP side of the table, LP, obviously institutional LP demand for private credit is continuing to remain strong, but are investors becoming more selective? What are LPs prioritizing today?
They're going into 2 directions, but the 2 directions might initially seem contradictory, but there is a good philosophy behind them. One of them is that there is general when it comes to sponsored deal, more middle of fairway, there is more consolidation among larger managers, and then because it doesn't really like make sense to create another de novo manager who does like broadly syndicated or middle market deals, sponsor-based deals. There are enough existing managers, enough middle market CLOs, enough broadly syndicated CLOs out there. On the other side, there are the LPs care about differentiated return and more niche exposure that they do also. There is a room in the portfolios, not really as core allocation, but as satellite allocation to the smaller managers. And it is, I think the space that you don't want to be is that you don't want to be a small manager that argues I should be part of the core allocation. If you're a small boutique manager, room for you there, but you need to know that your place is more like a satellite allocation. If you are one of the large scaled up, you do like some people essentially need to show where their alpha is coming from. Is my alpha coming from I'm niche small specialist that goes and like is willing to write checks of smaller size to my borrowers that bigger guys are unwilling to do? Am I going to be involved in a structuring, or do I take just syndication? Or is the value comes from, hey, I'm a large credit underwriter and I've scale, and because of my scale, I can do things that other people don't want to do. There is room for both of them. You just need to be very conscious around where you position yourself, what type of opportunities you are targeting. And the other thing is, we used to live in a world where people would look at maybe some ratios and metrics superficially. And the most, in my mind, egregious example of that is private credit being evaluated on the basis of a Sharpe ratio. Because if you are not a liquid vehicle, Sharpe ratio is meaningless. You might use your NAV as an input to calculate Sharpe ratio. You can create a vehicle that has a Sharpe ratio of 10, but is it really a Sharpe ratio of 10, or are you just doing a calculation based on a NAV that is not really the way all the underlying assumptions that went into calculation of Sharpe ratio historically were done. So I think limited partners are becoming very smart and sophisticated on analyzing opportunities. And the more people see, like, okay, you have essentially BDCs that may be trading at a discount to NAV. People understand that, Sharpe ratio is very good metric if you're looking at the portfolio of equity positions that you can liquidate in seconds, if not, within 24 hours. For credit, NAV is not necessarily has the same type of characteristics that you can use for doing a Sharpe ratio analysis. Your bid offer is so wide that Sharpe ratio analysis doesn't really apply.
What trends in private credit you think are currently underappreciated by the broader market?
Underappreciated trends. I think one of the things that I'm fascinated by in private credit or private credit adjacencies is the discount that you see in publicly traded BDCs and CLOs. But actually, before going to that, I think a trend that is underappreciated is that a lot of capital that has come to the space, especially in direct lending, sponsored base, sometimes it's insurance companies on both sides of the market. Like I was recently asked, hey, Ali, maybe private credit is taking away market share from banks' broadly syndicated loan activity. Are banks winning that back? And the interesting phenomena there that is less often talked about is, well, when a bank makes a loan and then broadly syndicates it, it goes to a CLO. It either goes to a broadly syndicated CLO, or in some cases, it might go into middle market CLO, depending on the type of loan that is, the type of bank that is, and the type of product that is being allocated. But the home for them is CLOs. And then the CLOs themselves are typically on the balance sheet of insurance companies. They can get, a lot of the capital structure can get rated investment grade. And, that ends up on the balance sheet of typically an insurance company. On the other side, the private credit managers that manage money also go and raise money from insurance companies. So in this supposed competition between broadly syndicated loan market and bank activity versus private credit, sometimes insurance companies end up being on both sides of that competition. And that to me is something that people are, especially regulators, are underappreciating around what is the capital, what is driving the spreads tighter. And maybe no one wants to get in front of that because, who had incentive in 2005 or 2004 to get in front of the housing market? You had no regulator, no politician, no political party wanted to be the person, regulator, entity that goes and crashes people's dream of home ownership. There was just not enough incentive for anyone to do that. Seeing a little bit of that type of phenomenon here, that is, spreads are at all-time tight. A lot of activity, CapEx for AI, to financing for middle market, smaller companies, to financing for home improvement businesses, or your dentist roll-ups. All of them are coming to the private credit market. There is limited appetite right now by any regulator to be seen as trying to discourage that from happening. Whether that's bank regulators, whether that is any essentially insurance regulators, they don't have that type of incentive to And it's less about like what I call compliance regulation and legal regulation enforcement. It's not about like whether your documents are there or not. It's more about, is this insurance company sufficiently capitalized? Is this bank sufficiently capitalized? The direction of the travel for the past decade has been less capital in the system versus larger notional amount of risk, on the theory that these things are investment grade and we are encouraging growth in the economy by making credit more active.
So a couple more questions before we get to some fun questions, and we wrap up in a little bit. What excites you most about the markets today?
I think that I'll start with our little niche market that we are seeing lending to other lenders. To me, like the way technology is impacting that and creating opportunities. We don't lend to tech. We don't lend to data centers. We lend actually to businesses that are generating collateral. As a lender to other lenders, we are seeing how those lenders are becoming very technologically savvy in the way they use technology. And some of these things are very futuristic. And I think actually very good for the end consumer. Like if you look at consumer loans, you might live in a world where some of your interactions are managed through AI. So rather than having a call center in Philippines or a call center overseas that takes calls, because for a lot of these businesses, managing costs is important. And sometimes they use overseas call centers, for example.
Mm-hmm.
Can we live in a world where you have an AI agent who can handle those calls? We are not there yet because like most of the voice agents out there run out of context after 5 minutes and they might start hallucinating. But if someone figures that out, that I think is a game changer. It's actually like safer for consumers. You don't need to worry about, you need to worry about compliance, but once you train your voice agent that, hey, if you want to sell a product, this is the way you are supposed to conduct yourself. You are not supposed to misrepresent stuff, but you are supposed to be helpful. There is an art to it. It can revolutionize how some of the business processes by the specialty finance lenders are handled. And I always wonder, which direction does that mean? Does it mean that it all becomes commoditized? Does it make it easier for new entrants to come to the market, or does the benefit accrue to the incumbents? The jury is out on that, but that's definitely like one of the more exciting phenomena.
What keeps you up at night?
As a lender to other lenders, my worry is that, we have had a very benign lending environment for the past 6 years, 7 years. Like, actually, since I started Monachil, we have had a very good environment for consumer lending. I happen to be more on the bearish side for that entire time, but it turns out that the environment was very good. Now I do worry that if there is a broader correction in the market, because, for example, AI capex spend stops, like some of the lending that we do is to companies that lend to businesses. Is construction companies that are doing construction for data centers are going to be impacted? Is that going to push up unemployment, actually, if people say, okay, I no longer am going to invest in data centers? The direct credit risk, we don't have direct credit risk to any of the AI capex type of borrowers. But you do wonder that do we get shrapnels of that if there is an explosion there, where, okay, people don't have money to buy cars or pay their car payments or pay their consumer loans because they've lost their job because there is not the construction boom in the US is coming to a halt. It's really about third order, second order impact of slowdown in capital deployment. Would that impact any of the lenders that we are lending to?
So I always end my episodes with some fun questions. So favorite sports team and or hobby?
Favorite hobby is, for me, even though I'm not very good at it, is combination of playing golf or skiing. Actually, I'm fairly decent. I do dabble black diamonds, and sometimes I stumble down a hill, but it's very fun.
What's your handicap in golf?
Hey, high doesn't prevent me from enjoying the game. It's
There you
about
go.
20, but I still love walking a golf course. It actually helps me. My favorite thing on the weekends is not to bring my phone with me and spend 2 hours, 3 hours walking and just relaxing and then thinking about problems that I have to deal with next week.
One surprising thing about yourself.
One thing that I was surprised was that I feel a lot of time I'm far more grateful for the opportunities that coming to the US has given me compared to people around me. People ask me what's your best trade, and my best trade is not whether I went short this or whether I went long this at Goldman or at Monachil. It's coming to United States has been something that I'm incredibly grateful for and have given me a lot of opportunities.
What is one book that you'd recommend reading?
The 7 Habits of Highly Effective People. It is not necessarily the most sophisticated book, yeah, but the principles are genuinely useful, and it's a book that I wish I'd read maybe 20 years ago. But nonetheless, I've very much enjoyed reading it.
Most exciting part of your job?
For me, it's the underwriting process and understanding these businesses, because as a credit investor, we get to see the tech stack, we get to see the and when we underwrite, we get to see the financial model, management team, the market that a particular lender is targeting. You get a lot of deep knowledge that maybe if you are just doing market trading or other types of equity underwriting, you wouldn't necessarily pay attention to. But as a credit underwriter, we are getting very deep on those aspects of the business, and to me that's very exciting to see, okay, how does this small lender, which market they are targeting, what's their niche, what's their strategy. And then we have seen lenders both be able to scale up and not be able to scale up, both succeed and fail, but make some people successful and some people failures.
And then final question, one prediction for the next 12 months.
I think that there is going to be some AI data center project will go badly. I don't know why, but I have a feeling that just given how much capital is coming to the space, there is something will go badly. It may not necessarily be Enron style or anything like that. It may not even be anything nefarious. It may not be systematic, but I think life is usually more complicated than, hey, I'm going to buy some GPUs and connect them to electricity, and voila, I can just list them at a premium. Then always it comes to, okay, what would the second order, third order impact of that?
Yeah. Well, I think that's a good place to end it, Ali. Thank you very much for your time. I really appreciate it. Wish you and the team continued success.
Thank you. Thank you very much.
Thanks, Ali.
Cheers.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.